Yeah, very good afternoon to the viewers of today's VCM on research finding on transfer pricing in the post-BEPS world, intangible perspective. The hosting branch is quota branch of CIC of ICAI and being organized by the committee, research committee of ICAI, the one of the oldest technical committee of the ICAI. We have the presence of our learned chairman, Sri Anuj Goyalji with us. We have the hosting branch chairman, Sri Lokesh Maheshwari ji, Tushar Dhingra ji, Treasurer, and we have Neetu ma'am and other office leaders, Devendra ji and Devendra Kataria ji and Deepak Shingla ji with us to grace the occasion. So, not taking much time, I would request Chairman to the Quota branch of CIC of ICAI for offering his welcome address. Over to CA Lokesh Maheshwari.
Thank you, Amit ji. I CA Lokesh Maheshwari, Chairman Quota branch of CIRC of ICAI, welcomes you all in the today VCM research finding on transfer pricing or in the post BEPS world intangible perspective. I welcome our Honorable CCM CA Anuj Goyal ji, Chairman of Research Committee, and CCN CA Pramod Kumar Bhog ji, Vice Chairman of Research Committee. I also welcome our today eminent speaker CA Ajit Kumar ji Jain. At last, I thanks to the Research Committee for giving such wonderful opportunity for hosting such wonderful program to Quota branch. Thank you. Jai Hind, Jai ICAI.
Thank you, Lokesh, for your warm welcome address. And now I request CA Tushar Dhingra ji to kindly briefly introduce our session speaker, CA Ajit Kumar Jain. Over to Tushar.
Thank you so much. It is an honor to introduce our today's speaker. CA Ajit Kumar Jain is a chartered accountant and company secretary and has an extensive experience of more than 10 years in the areas of international taxation and transfer pricing in India and abroad. He is currently working with PwC, Middle East in International Taxation Department as a senior manager and a digital accelerator. He has written and published various articles on transfer pricing and international taxation. Amit ji.
Thank you to Sarji for giving a brief intro of our session speaker. Ajit Kumar Jain ji is a company secretary and PA, and through his vast experience, we are sure that he would be giving us new insight about the subject. So now I request CA Neetu ma'am, past chairperson of Quota branch of CIC of ICAI, to kindly take a drive and introduce us about our worthy chairman, CA Anuj Goyal. Over to Neetu ma'am.
Thank you, sir. Very good afternoon to all respected members. Today, I would like to introduce one of our Central Council members, CA Anuj Goyal, sir, which is an ever-smiling personality I have seen. Welcome, sir. Anuj Goyal, sir, is the Central Council member of the Institute within his 14 years in Council. So, great term. 3 years in 3 years in Regional Council and 6 years he have already served the branch. He contributed his contribution is immense in various capacity. Presently, sir is the chairman of Research Committee, which is the oldest one of our institute, and he is also and the Capital Market and Investors Protection Committee of Institute. He is also vice chairman of Corporate Law and Corporate Governance Committee with his exemplary academics. So, जो कि count करना ही बहुत ज़्यादा है. He possesses की जो degrees है, he CA, CMA, CMA which is ICWA, LLB, MCOM, DISA, DIRM. A warm welcome to you, sir. And sir, इतनी degrees में से आप हमें भी guide करें कि आप किस direction में जाना है. We welcome you, sir. Thank you, sir.
Thank you, Neetu ma'am, for your giving a brief intro of our chairman. And I'm fortunate enough that I served with him in 5-6 committees as secretary and he's a chairman. So during his 14 years of the tenure in the council, I would like to share some of my experience with him or something about him to the viewers that he's a member of all the three institutes at the age of 20. At the same time, he served the three sister institutes at the same time also when he was managing committee member of Ghaziabad branch of CRC of ICAI. At the same time, he was chairman of ICSI also at Ghaziabad level. He was chairman of ICWAI also at Ghaziabad. So he decided himself to serve to this community, the three of the sister institutions. So from beginning, at the age of 22 years, he has started to serve the profession. Then he spent 6 years at branch, then 3 years as a chairman of youngest chairman of the CIT, and then there was a time when he was chairman of the Central India Regional Council. At the same time, he was Central Council member elect also. So more than half of his life he has contributed for the profession. So not taking much time, it is worthy to listen a person like C. Anuj Goyalji. So over to C. Anuj Goyalji for his guiding words and opening words. Over to C. Anuj.
Thank you, Dr. Amit Kumar Agwalji, our Honorable Secretary of the Research Committee, our young and dynamic Secretary of the Research Committee. I welcome our Honorable guest speaker, CA and CS Ajit Jainji, on behalf of the Institute of Chartered Accountants of India and on behalf of the Kota branch, which is one of the most prominent branch of Central Region and one of the most prominent branch of our country. And Kota is practically the educational capital of the country. And I'm quite confident that Kota, which do produce the best of the chartered account, best of the IITians, and also do produce the best of the chartered accountants also. And some of the best chartered accountants, they do retain for their own consumption, and the rest of the chartered accountants, they are sending in other parts of the world. So the best of the chartered accountants, the leaders of the Kota branch are with us. Our Honorable Chairman, CA Lokesh Maheshwariji, our Honorable past Chairperson, the Chairperson in the very first year, CA Neetu ma'am, and we are having the presence of our very, very prominent leaders of the profession, CA Deepak Singhal ji, CA Devendra Kataria ji, and our Dhankube, and the chairman of the students, Sikasa chairman, to CA Tushar Digra ji, and all other managing committee members of the Kota branch. I think Rajni Mittal ji, our immediate past chairperson, will also be joining us very soon. And all our honorable viewers from each and every part of country and outside country. We are having 4,000 plus delegates for this virtual CP meeting. That shows the importance of the education for the chartered accountant, and that shows the prominence of the Kota. When Kota is there, each and every one want to be the part of that program. In this very, very important virtual CP meeting on research findings on transfer pricing in the post BEPS world, intangibles perspective. And friends, I'm quite confident that all of you must be taking very, very good care of yourself and your family members. And at Kota also and other parts of the country, also we must be trying to see that each and every family member of chartered accountants is vaccinated. And I think through these knowledge enriching programs, we are trying to have virtual programs through our research committee, through our committee on capital markets and investors protection, to see that how our chartered accountants can be engaged in the knowledge addition activities and can be away from negative thoughts and negative news, which is there everywhere, whether it is social media or electronic media. And in turn, we can learn and can contribute for the cause of the profession and for the cause of the nation. So I hope that all of you are safe and sound at your place. Friends, it is a wonderful journey of 71 long years of the Institute of Chartered Accountants of India in the service to the nation. And it has always worked for the best of all its stakeholders, aided the government in its endeavors, and always been a partner in nation building, which was rightly said by none other than APJ Abdul Kalam, the former president of the country. Friends, the institute has achieved recognition as a premier accounting body, not only in the country, but also globally for maintaining highest standards in technical and ethical areas. At the outset, I would like to mention that the research committee of the Institute of Chartered Accountants is one of the oldest technical committee set up way back in 1955 with a view to undertake research activities to services rendered by the professor. To improve the quality of the services, it is endeavor of the research committee of ICAI that we regularly update the members on the burning issues and topics. And friends, fortunately, I was the chairman of the research committee last year also. Dr. Amit Agarwalji was the secretary. And in spite of the corona pandemic, we tried our level best to see that how the backbone of Institute of Chartered Accountants of India, the research is supposed to be the backbone of any organization. And when we do talk of the educational bodies, I think it is further more important. And when we do talk of the statutory body, which do produce the best accounting professionals across the globe, I think the research, the importance of research is very, very important. So last year, when we got the opportunity to serve as the chairman of the research committee, in spite of this corona pandemic, we took a lot of initiatives. One such initiative was ICAI Doctoral Scholarship Scheme. The ICAI Doctoral Scholarship Scheme is open for all the members of the institute who are pursuing PhD and are not more than 40 years of age on the last date of application. The scheme aims to provide scholarship to the eligible candidates having outstanding academic record in 10th and 12th standard and an inclination and commitment to undertake research in the areas such as auditing, taxation, commerce, management, and accounting discipline. Friends, the scholarship of rupees 50,000 per month for 3 years will be given for 5 scholars. The last date for submission of the application for ICAI Research Doctoral Scholarship Scheme has been extended till 31st August. So I will request all the viewers to see that how we can be the part of this ICAI Research Doctoral Scheme. Then last year itself, we introduced for the first time in the history of the institute ICAI Research Project Scheme. ICAI Research Project Scheme is open for members having experience of more than 10 years, Neetuji, whether we are in practice or in employment. And the maximum amount of rupees 10 lakhs will be given, will be reimbursed to the eligible researchers. The applicants will be given the time duration of 6 months for completing the research projects after the research proposal is approved by the research committee. So this scheme is also open round the year. So I will request all our honorable members to please see that how we can come forward and be the part of this initiative of the research committee. Last year, Tusarji, you will not believe that in spite of the year was affected by the corona, we approved 7 research projects, Ajit Janji, and all those 7 research projects were completed within the given time frame of 6 months, and all those research projects were very, very good for the profession and for the nation. And 2 of the researchers have denied to take even the reimbursement of the expenditure. So this is the commitment for the mother institute. And 2 of the researchers were from other parts of the world. They were not in India, but were serving in other parts of the world in the education industry. So I'm really very happy that this initiative of ICAI Research Committee, Research Project Scheme was appreciated by each and everyone in each and every part of the world. Then for the first time in the history of the accounting profession, ICAI International Research Award was launched last year. Institute of Chartered Accountants of India is the only accounting body in the world who launched the ICAI International Research Awards, Neetuji. And this award could be considered as the world's largest cross-border competition with an objective to encourage and provide recognition to research scholars across the globe and their contribution in fostering research studies leading to innovation and value creation. The scope of the awards would be to identify the topics of international and societal importance encompassing areas of accounting, auditing, economics, finance, and taxation. And the last date for submitting published research paper is 31st May. And you will not believe, Lokesh Maheshwari ji, last year, in spite of the fact that the whole of the year was affected by the corona pandemic, we got close to 100 entries from each and every part of the world. And more than the chartered accountants and others from more than 10 countries were identified, were shortlisted for the awards. And this year, Lokesh, this year we are going to have this award ceremony at Gulf countries in Dubai, where we are a very, very strong presence of the members of the Institute of Chartered Accountants of India. In the month of August or September beginning, Ajit ji, we are going to have this award ceremony in Dubai. And Lokesh ji, the immediate past president of International Federation of Accountants, IFAC, was the jury chairman for this International Research Award. And the president IFAC was one of the member of the jury last year, and this year also the IFAC president of the International Federation of Accountants is the jury chairman. So I will request all of you to see, we are having only 2 days left to got the nominations. So how we can get the best of the nomination for ICAI International Research Award. I will request all the viewers who are there in very, very big number from each and every part of the world to come forward for this ICAI International Research Award. I think more than 4,000 viewers are live with us in this virtual CP meeting. Then ICAI Awards for Excellence in Financial Reporting. Friends, ICAI through its research committee has been making sustained efforts since 1958 to promote high quality financial reporting through the annual awards competition, ICAI Awards for Excellence in Financial Reporting, wherein the entities are being recognized for following sound financial practices amongst their peers. The awards are open for corporates to submit their annual reports in order to recognize and encourage excellence in preparation and presentation of financial information. And last year, we had received the highest number of entries for the awards in the last 7 years, in spite of the fact that the year was badly affected by corona pandemic. And we are expecting the highest number of entries in this year, in spite of the, this year is also very badly affected by the corona pandemic. Friends, this year categories of awards have been revised. A new category of municipal body has been incorporated, and the last date for submitting the entries is 30th September 2021. So I will request all our honorable viewers, all the members of the Institute of Chartered Accountants of India to ensure that how we can have the more and more entries for ICAI Research Awards for Excellence in Financial Reporting, so that the best of the corporate can be awarded. Then friends, ICAI has always dealt with hardships and responded to the time of crisis. Every challenging circumstance which presents disorder and fear is the best occasion to learn more and fear less. Amidst the chaos caused by the global pandemic COVID, the ICAI has come up with several enabling measures and initiatives to promote knowledge as the ultimate weapon. The Institute has always remained at the technological forefront. ICAI has always been keen towards adapting and upgrading the skills of professionals in tune with changing requirements. We understand the importance of knowledge sharing for not just individual enrichment, but for all-round societal benefit. I think one of the most important reason that our chartered accountants are updating their knowledge on day-to-day basis is to see that how we can really do something concrete, not only for the profession, but also for the trade and industry, and in turn it would be beneficial for the nation. Against this backdrop, the research committee has come up with this virtual CP meeting on research findings on transfer pricing in the post-BEPS world. Transfer pricing has become one of the most international tax issues in the world. With respect to the transfer pricing, 4 specific action points in the OECD's BEPS report are of importance. In the world of transfer pricing, intangibles is a complex area. A lot has been discussed and debated over the definition of intangibles, identification of intangibles, and the arm's length nature of intangibles. Amongst the transfer pricing transactions of M&E groups, transactions related intangibles are the most significant and susceptible to dispute with tax authorities. In the post-BEPS world, intangibles would be the heart of the transfer pricing analysis. Therefore, in this research case study, the researcher, our learned speaker of the day, CA Ajit Jain ji, evaluated the impact of the OECD's BPS guidance on transfer pricing from an intangible perspective by critically analyzing the OECD's guidance under Action Plan 8 to 10. Also, he has analyzed if there is any alternative to the arm's length principle. With this, without taking your further time, I take the pleasure in welcoming the dynamic speaker of the day, C. Ajit Kumar Jain ji, to present his research findings on transfer pricing in the post-BPS world, intangibles perspective, and enlighten our knowledge with his words of wisdom. And as I conclude, I will request once again to all our honorable viewers, particularly those who are in our country, as now the second wave of the corona pandemic is coming down, but still one has to be very, very careful. And I will request all of you to see that how our chartered accountants and their family members are vaccinated at the earliest. And I will request Kota branch to ensure that if we can have the vaccination drive for all the members, particularly those members who are in the age bracket and their family members who are in the age bracket of 18 to 45, I think it would be really good service, not only for the profession, but also to the society and in turn for the nation. So without taking your further time, I once again welcome all our honorable viewers from each and every part of the world. Around 5,000 viewers are there from India and outside India. And I am really indebted to the Kota branch, one of the most prominent branch, the best branch of our central region, led by C. Lokesh Maheshwari ji, the chairman, and Neetu ji, the past chairperson, and Tushar Dhingra ji, and Devendra Kataria ji, Deepak Singhal ji, and other office bearers of the Kota branch. Thank you very much.
Thank you, Chairman sir, for your words of wisdom. And in your opening remark itself, you have given us an idea what is going to be deliberated in the whole session. And you have given us you shared some information, some initiative taken by the committee. There are a lot of things that can be shared, but time is a constraint. And we are on a topic that is very, very important for our profession. And the speaker is also there. So I'm not coming in between to that deliberation, and at a later or other platform we can discuss other things also, the initiative and other things. But the way you summarize in your 10 minutes deliberation, the way you describe what is going to be, what is the finding of study, that shows how you read. I could see in morning you was with me in one of the program. After that you was in a branch program. Now you are in a program, and 6:30 you have another program. I couldn't understand how you read a whole document. Even it is very difficult for a researcher who did research. How you could find that time to read out these slides and everything. So really kudos to you. And with these words, now I request Ajit Kumar Jain ji, learned speaker, to kindly deliberate on the topic. Ajit ji.
Yeah, sorry, I was good. Thank you. CA learned Anuj ji, Dr. Amit Agarwal ji, CA Lokesh ji, CA Tushar ji, CA Devendra ji, Neetu ji, and all other committee members. First of all, I would like to thank you for giving me this opportunity to present on the important topic of transfer pricing in a post-BEPS world intangibles perspective. Before going into the presentation, I would like to talk about my motive to write a research paper on this. As Anuj sir mentioned about the value creation, any guidance or anything, any regulations, unless there is a value is not created, we don't get something out of it. So, Anuj sir has rightly mentioned about the value creation, and that's what the ICAI is very aggressive in terms of taking a lot of initiative in research projects and giving motivations to the members. And that's the reason why I have researched this. I have researched and written this research paper on the very important topic of transfer pricing in the post-BEPS world, specifically intangible perspective. Now, if I talk about this research paper, the idea was to give a due importance to the intangibles in today's dynamic world. If we really see, the world has been changing a lot, and over the period of years, transfer pricing is one of the most important international tax issues in the current scenario. It is the most contentious issues, and tax authorities across the globe are very much concerned about getting the fair share of their tax revenue. Now, over the period of years, what I realized as a professional is that due importance is not given to the intangibles, and that is what is the most important thing when you talk about any business or any business model or any organization. The returns or the compensation is based on the contribution of the intangibles, and we cannot simply take any subject as a compliance subject and just do the compliance. If I really talk about transfer pricing, to be very honest, transfer pricing is not the compliance subject only. It's a mix of accounting, legal, economics. You have to see a lot of things in one subject, and you have to align with the business. Now, today's discussion on the transfer pricing in the post-BEPS world is all about, to change the little bit of perspective about transfer pricing, the real objective, rather than taking into this subject as a compliance subject that at the year end, you just need to file some form, compute the arm's length price, and you are done. But that is not the objective. Transfer pricing is a global concept, and it is introduced, and being a global concept, it is very important to align with the globally accepted principles. Now, when I talk about the globally accepted principles, there is a OECD guidance which is available. United Nations come up with their guidance, and then various countries across the globe introduce the transfer pricing regulations. Now, having said that, it is very important to understand that the objective of transfer pricing is not just to comply with the particular regulation, local regulation. And transfer pricing is an anti-avoidance tool, which means that this tool helps in avoiding shifting of profit from a high tax jurisdiction to a low tax jurisdiction. And just because you have done the compliance, it does not mean that there's no shifting of profit from one country to another country. In fact, after so many years, OECD has recognized and OECD observed that even after there's a lot of compliance already been done, the companies or the taxpayers or the countries have followed the arm's length principle. Still, there is a shifting of profit. There is a base erosion which is happening. So, what is the next solution? The solution is not to having more and more compliance or more and more regulation. The fundamental solution is to look at the substance. What is the substance behind any transaction, any model? And that's what, this is the new, OECD guideline has come into the place. Now, so let's, with this background, let's start with this presentation in terms of what are the key guidance, key principle coming out from the OECD's guidelines. So in this presentation, there is a pre-BEPS guidelines and there's a post-BEPS. But first, we need to start with what is base erosion and profit shifting. That is what is most important. And then we'll talk about that what was happening in the transfer pricing in a pre-BEPS world and what is now being followed. And we also discuss whether it is practical for each and every country to follow this post-BEPS guidance, because it may not be necessary or practical. One thing which is just to be followed by developed countries, same thing might not be followed by a developing country. So one might, suitable for a country like US, where the most intangibles are being developed, and the other stuff might not be relevant for the India, which is, where most of the development of that, or I would say enhancement of the intangible is made. Now, with this background, what is the base erosion and profit shifting? Now, you must have seen that, there are regulations. If I talk about tax regulation or transfer pricing regulation, there could be a possibility of any using any benefit or using those regulation for the benefit by using the loopholes of those regulations. Now, base erosion and profit shifting refers to certain tax planning strategies. Okay, so and that strategies could be exploiting gaps and mismatch in the tax rules, so in the tax rules, there might be some gaps and mismatch. And with that gaps and mismatch, you can, exploit the possibility, and you can shift the profit from one jurisdiction to another jurisdiction. And I want to give you one simple example of here, since we are talking about base erosion and profit shifting. Suppose I'm paying some support services to my related party. I'm a company based in India, and I'm paying my related party in Singapore for some accounting and payroll services. Okay. Now, what is happening is I'm paying that charge. I'm computing the arm's length price, which is an arm's length. But what is happening is, at the end of the day, I have also recruited few people in my company in India who are doing the same work, and that's where the whole problem comes. As I mentioned, it is not always necessary that if you computed the arm's length price, you are done. Still, there is a possibility of base erosion. The moment you are making the payment, and the moment you are recruiting people in the same country in India, in your company, who are doing the same work, it means you are duplicating this. You are duplicating some sort of work, and since you are duplicating some sort of work, you are taking the disallowance for both the things, and that is not in line with the transfer pricing principles. The transfer pricing principle says, the new principle says that whatever you are entering into a transaction, that should have a substance. And if the moment you are duplicating anything, you are increasing the cost without any need, then it actually fails the entire purpose. So that's what the example is that, I'm bringing out in today's presentation, that substance is really very important when it comes to transfer pricing. It's not only the answer. And second is, one is exploiting gap. The second is to avoid shifting of profit from high tax jurisdiction to low tax jurisdiction. And that's where this base erosion profit shifting is very concerning for the tax authorities across the globe. Tax is a very most important source of revenue for each and every country. And no tax authority would like to see any sort of erosion, because that is, is very harmful for any country. No country wants to see any base erosion, because end of the day, it would there would be loss of tax revenue, and it would hamper the overall development activities. So that's what the transfer pricing is the way more important in today's scenario in the overall international tax world. And you have seen in last 2 decades, there has been a significant amount of litigation happening in India and across the globe. India is the forefront of the transfer pricing litigation. But as I mentioned, transfer pricing is not only accounting or legal subject. It's a mix of everything: accounting, business, and one should keep in mind that the transfer pricing should be aligned to the business realities. Unless it is not aligned to the business realities, it will not give the required results. With this background, let's move on to while I have spoken this, but let me talk about further more on this aspect, that these days, in the current scenario where things are changing quickly, you must have seen, not only in a post-COVID era, but pre-COVID, things have been changing in terms of globalization, digitization, complexity in the value chain. And after COVID as well, the business model is changing. Now, the question which comes, in terms of the transfer pricing, that how long is the existing transfer pricing regulations are, applicable in the changing business model or business scenarios? I would say, it's not that easy answer to give, because there have been significant changes is happening. Like, say, for any FMCG company after post-COVID, many companies are trying to shift their supply chain to reduce their cost and everything. And that has a direct, indirect impact on their transfer pricing, policies. And that resulted into entire, overall their policy and the overall results of the transfer pricing. So having said that, it is very important to evaluate the current changing landscape in the business and the operations, and then look at the business reality, and then see what it is impacting from a transfer pricing perspective. What is happening, with these all changes? Government is taking more attentions that what is happening changes. It's not about the legal interpretation of the law. government is taking more attention to the business model, how they are changing, and what does it impact on the business overall tax liability and the overall transfer pricing policies. More complexities will come in tax laws, in transfer pricing. And the third thing, more information sharing. You must have, aware about the CBCR regulations and other master file requirements. All these things are, coming up because the government wants more information, and not only from one country, but for different countries. They want for a particular group, and then more scrutiny will come. So if we see this really changing this scenario, aligning transfer pricing policy with the business reality is very, very important. One cannot just go and interpret the legal aspect and do the compliance. One need to see the business reality. But at the same time, there are challenges also in terms of ease of doing business. Government wants ease of doing business, but at the same time, how to balance between the more complex laws and at the same time ease of doing business. So I would say this has been a challenge, not only from this law, but all across all regulations. Government, whenever a new law or regulations comes, government needs to think how to introduce this at the same time, protect the concept of the ease of doing business. And then the second thing, the fairness of the tax burden. Tax burden is a more challenge in terms of the companies who are operating in India or outside countries. They need more ease of doing, they need less of burdens when it comes to taxations. So all these challenges are there. So with this background, this is the changing landscape in terms of the business, changing landscape in terms of the transfer pricing, and overall, how we deal with the transfer pricing. That is what is more important. Let's look at the pre-BEPS world, what was happening in the pre-BEPS world, how we used to deal with the transfer pricing. Now, in the pre-BEPS world, what we used to do as a transfer pricing, compliance is basically, we used to, perform the comparability analysis, compare the transaction or the entity with the third-party independent comparable companies. We recognize the transactions. We select the most appropriate transfer pricing method, and we compute the arm's length price by using the databases and benchmarking. And this has been the practice. And as I said, OECD observed that even after following these guidelines, these principles, still there is a base erosion. Why there is a base erosion? Because the substance is missing. I mean, even if your price is arm's length, but the real substance, the real business reality is totally different. So I took an example of the intra-group services where the transaction, while payment is arm's length, but I am taking double advantage by recruiting more people locally and also paying to my related party, and that brings a question on the overall substance. So in summary, the pre-BEPS world, the substance was already a topic was there, but it was not explicitly mentioned in any guidance. However, in the post-BEPS guideline, the substance was clear, comprehensive, and how to use with the pre-specified methods. So this is a pre-BEPS world where certain procedure was followed, certain substance was there. So I have seen in the pre-BEPS world, meeting with the tax authority, they have been asking about substance, but it was not specifically coming out from some guideline. Now let's take an example in the pre-BEPS world, what it was, how the compensation was happening in the pre-BEPS world. Suppose a company is based in USA, and it is the legal owner of the intangible developed over the period of years. So US company is developing a legal owner, developing a brand or a technology over the period of years. The role of company A is only to protect the legal ownership of the intangible and make the acquired investment of the development. Company A, what it does, it gives a license to company B for further research and development. Company B do some research and development, further develop, make some R&D, market development, and also takes significant amount of risk in that development. Now, in the pre-BEPS world, what is used to happen that just because a company developed the intangible over the period of years, company A is taking the most of the returns, not only due to the fact that it is a legal owner, but also from the research and benefit of the research and development, which is done by company B. Now, this company B is doing the R&D, research and development. it is allocated to a minimum routine return, say some cost plus margin. But if I talk about company A, it is taking the maximum returns, and those returns, in fact, the efforts which is done by company B, the returns goes to company A because the company is the legal owner. It has invested everything, capital. That's the real issue which has come up, that why company B is only remunerated with the routine returns while it has taken the significant amount of risk in its R&D, research and development activities. And because of this issue, the company A is getting the maximum return. Now the debate has happened whether the capital investing company will get the more return, or a labor intensive industry will get the more return. Now that's what the thing is, that the economic owner, which is the labor intensive company, should get the more return, who is taking the more risk. So here the changes, the entire changes in the pre-BEPS and post-BEPS world. In the pre-BEPS world, legal owner will get the maximum return, but in the post-BEPS world, the company will contribute to the entire analysis, assume the maximum risk, will get the most return. This is the change. And even if the company justify the arm's length price based on the routine return, it is automatically not concluding that there is no shifting of profit, because there is no substance in company A in relation to the research performed by company B. A is not entitled to the incremental return. What is post-BEPS world changing? In the post-BEPS world, basically, new companies, the companies which are conducting more, activities or taking significant risk would be get more. We'll talk on more about it when we talk about all the action plans. But if we talk about the base erosion profit shifting plan, the OECD which has come up, the objective is to minimize the taxation in the source country, low withholding tax, low or no tax at the level of recipient. So these are the fundamentals which, the tax planning is moving profit to a low tax jurisdiction. And the another objective is growing perception that the government lose substantial tax revenue. As I said, that this is the gray area where government wants to work, and that's what the OECD also help in coming out with the detailed regulations. So while in this analysis I'm talking about action plan 8 to 10, but if you talk about there are 15 action plans, and those action plans are focusing on these objectives that there is a shifting of profit, there's a loss of tax revenue, and bringing more transparency in terms of the tax. And that's what the base erosion and profit shifting plans have been introduced. Now, what does this new BEPS guidance is coming into? As I mentioned, intangible plays a very, very important role in terms of the business and compensation. And until any guidance or any regulation don't define intangible property, it's really difficult to find out which entity should get the more return. So what happening is OECD in the new guidance, which is introduced in 2014 draft and implemented in 2015, in this new guidance, the OECD has broadened the definition of intangible. No clear distinction made between trade and marketing intangible. Marketing intangible is a big area of dispute when it comes to India, and it's more broader in terms of. We'll talk about more in terms of definition, but it makes very broader. Say for example, any intangible. If it is not accounted in the books, not necessary that it is not an intangible from transfer pricing perspective. So any intangible from a transfer pricing perspective may or may not necessary that has to be recorded in the books as well. So that kind of definition has broadened into. So you might have seen that there are intangible which are not there in the books, but from a transfer pricing perspective, we recognize and we report transactions in the particular form of transfer pricing. So first and foremost thing they have done is that they have introduced the new definition of intangible. The second is the DEMPE analysis. We'll talk more about this. Is a very, very important tool, and I would say this is the heart of the entire the new regulations. While if you see the entire transfer pricing analysis, functional analysis of the intangible was already there, where we do the detailed function assess risk analysis. But as I mentioned, just because we have done the function analysis, does not conclude that who is the real owner of that intangible, who is really contributing to the significant economic activities of the intangible. So this is, I would say, a second layer of the DEMPE analysis to identify which is the key entity who is contributing the most of the in terms of development, exploitation, maintenance, production, exploitation of intangible. So the full form of the DEMPE is development of intangible, enhancement of intangible, maintenance of intangible, protection, and exploitation. If you are fitting in this framework, you are entitled to a return based on the arm's length principle. Now, earlier this principle was not there, so the analysis which has been done based on the function analysis might not cover the entire picture in terms of the significant economic activities. Now comes to the ownership. This is again a very important concept: ownership of the intangible. While suppose I am a company in US and I have developed a particular product from last 10 years before, and I'm the legal owner of the intangible. It means I have registered that intangible in US, and it is now registered, protected, technology protected, and trademark. Now what happening is, the question is whether as a registered owner of the intangible legal, should I entitle to the entire returns which is generated by the efforts made by the other entities as well on that intangible? While I developed this intangible 10 years ago, but it might not necessarily that today I'm doing some enhancement, some other entities of my group is doing some enhancement. So in that case, the question is that I as an investor or I'm funding that R&D or research should get the entire return, or the entity who is doing that research or doing that contribution in enhancing that development should get the returns on that intangible. So that's what the question which we'll understand further in this guidance, and that's where the problem arises. I mean, just because I'm a legal owner, I'm the investor, I should not get the entire returns. And that's what OECD is trying to recommend, that while your transaction is at arm's length, but end of the day, it is, there's a base erosion happening because India is contributing a lot in terms of the value creation, but the entire returns is going to US. So moving on to the overview of the action plan 8 and 10. This is the three important aspects or action plan introduced by the OECD in terms of the further guidance, further layer in terms of which entity is entitled to the returns. Now, if I talk about the action 8, which specifically focuses on intangibles. So first thing they have done is the wider and clear definition of intangible, introduction of 6-step framework of the transfer pricing. We'll talk about what are the 6 steps in terms of getting to know which entity should get the returns or compensation from the intangible, and then focus on DEMPE, development, enhancement, maintenance, production, and exploitation. And the last is hard to value intangible, and this is very interesting. We'll talk more about it. So these are the aspects of intangible. Now, the second aspect is risk and capital. Now, along with the DEMPE analysis, which is more on analyzing which entity has contributed significant economic activities, risk is also important, and this is due importance is not given so far when it comes to transfer pricing analysis. If you have done, or if you have performed, or if you have seen any transfer pricing documentation, you must have seen functions, assets, and risk and all by and you do this based on the interviews of the business people or of the companies and various other people. But in this new guidance, the OECD focuses on more specific focus is given on the risk. And when I talk about the risk, it means actually controlling the risk. It does not mean that any entity is assuming the risk. It is not. It is controlling as well. So controlling the risk is very important, and in that control, decision making, how you respond to the risk, how you mitigate, that is very important. And then capital also. Capital means your financial capacity to take the decision or assume the risk. that is very important. And then there are other stuff which I'm not covering to this presentation, but because those are not specifically relevant other than profit split method. Profit split method we'll talk a little bit later, but there are other high risk areas like intragroup services and recognition of transaction. But for our analysis from an intangible perspective, Action 8 and Action 9 is very, very important. Now let's talk about this Action 8 of intangible, which is what is called as an intangible. Earlier it was a very generic definition in the pre-BEPS world. Now after the OECD, it is very important to understand. So when we do any analysis, transfer pricing analysis, as I mentioned, it is not necessary that something is not there in the books of account that is not to be considered as an intangible for transfer pricing purposes. Anything which is not there in books might be very well can be considered for the transfer pricing analysis as an intangible. So intangible is something which is not a physical assets or financial assets. Physical or financial cannot be intangible, which is capable of being owned and used in a commercial activities. So anything which is not used in commercial activities cannot be considered intangible. Intangible has a prime or major role to play in any business operations. And one another thing, whose use or transfer would be compensated has it occurred between the independent parties. So today, if I have an intangible, and tomorrow if I want to sell that intangible, there has to be a transaction happen as if there are happen between the independent enterprise. So it has some commercial values outside the company. Okay, so these are the broad definition of intangible. Now, what are the intangible which are relevant for the transfer pricing purposes? Patents, know-how, trademarks, trade names, right contract, and government license, and similar rights in intangible. So these are the if you see any transactions, any goods and services, or intangible transactions, you will see that any of those intangible would be part of it. Either it can be intangible itself. So suppose you are transferring any patent, selling any patent, or suppose you are selling any goods. So in both these transactions, intangibles are involved. If you are selling any goods, you will sell not only goods but the intangible as well, because there's a brand involved. There's involvement of brand in the sale of goods. So what are those things which are not intangibles considered group synergies? Now in the pre-BEPS world, group synergy, there might be debate that group synergy might be considered. What is a group synergy? It means if there are 2-3 entities and something is beneficial coming out of it by synergy made by group entities, while it should be considered while doing any while making any transfer or any compensation, but it should not be considered as an intangible for which a separate compensation is required. Group synergies is not considered as an intangible. Market specific features not considered as intangible. Assembled workforce, any workforce specifically working for a group is not to be considered as intangible. So these are the intangible where there's no external commercial value outside the world, where there are definitely benefit which is part of any compensation, but specifically there's no these things are not considered as intangible. You must have heard about the concept of locations, which is which has become more famous in India, that any entity is shifting the operation to India, and it actually saved a lot of money in terms of shifting. So the Indian entity should pay, Indian entity should receive the compensation for that location savings. Now that sort of things are happening now after this guidance. It is more clear that location saving there's no separate compensation required for the location saving, because location saving is not an intangible. It's a kind of benefit which is already part of the compensation which is made by or received by the Indian entities. So this is a broad definition of intangible introduced. So while analyzing the intangible, it is very important to see these aspects. What are those aspects? The aspects is exclusivity. The intangible has to be exclusive. It should not be routine intangible. Anything which is routine, it can be intangible, but there's no separate compensation required for it. So from a transfer pricing perspective, which requires separate compensation, we need to look into this area. Exclusivity, extent and duration of the legal protections, how much period it is active for, geographical scope, useful life, stage of development, if it is some intangible is not fully developed, it is very important whether we should consider as an intangible at this point of time or later point of time, right to enhancement. If anything is not further developed, can we still consider as an intangible or not? Or it is just a, kind of a thing where a compensation is not warranted year on year, and then expectation of future benefit. But because any intangible, if you're not getting any benefit, is not said to be an intangible. So these are the aspects we need to see in terms of the, what is the definition of intangible. Now, this is very, very important concept when it comes to the new guidance introduced by the OECD. One thing we need to understand that earlier the concept was contract. Whenever we do any transfer pricing analysis, we always ask, or when we always see the agreement between the two related party, and that is called contract. And that's where the whole problem comes, that it might not necessary that what is written in the contract is possible, that the actual conduct is the same. And that's where the problem is. And I give you a simple example. I am a cost plus support service provider to a US entity. I'm an IT back office service provider. I'm getting cost plus remuneration. And it is very well written in the agreement. Now, what is happening is, if I am a cost plus service provider, and as a cost plus service provider, I supposed to take routine activities because my return is assured. I'm not taking any return. I'm not taking any risk, and my compensation is assured to cost plus 10%. I can never incur loss because my return is assured. But what is happening is, if I really go into and interview the people of the company and see the actual conduct, what is happening is the company is undertaking much more function than it is written in the contract or agreement. While agreement says that the company is conducting only routine function, but the real conduct says the company is negotiating with the third-party vendors, or company is taking significant risk in terms of doing its functions and all those things. So as I said, that it is very important to see the business reality. The moment I see that the company in India is while as per the contract, it is a cost plus service provider, in real sense, it is a negotiator. It is taking a lot more risk. And ideally, for such a decision maker, a cost plus method is not appropriate. While you can consider cost plus and determine arm's length price, but it is not aligned to the real substance. So in the new world, one need to understand the real substance of the transfer pricing. And the real substance of transfer pricing is aligning the transfer pricing outcome with the value creation. If I'm doing a value creation as a decision maker, as a negotiator, I should not get cost plus 10%. I should get more compensation, like some commission or some other sort of lump sum compensation base, which is aligned to my function. So that's where the tax authority may challenge this entire model, that although you are a cost plus, you have determined the arm's length price, but looking at the function, you are doing much more than what is written in the contract. And that's where the whole debate of the contract versus conduct come into the picture. And that's where the OECD has come up with a different new guideline. There are the 6-step process, which is identified by the or come up with the introduced by the OECD in terms of the determination or the compensation or the margin which is required to be compensation. The first step is identify the intangibles and economic significant risk. It is very important to what is the intangible. Now, in my example, the intangible is owned by US. So I identify, okay, based on the review of the contract and based on the looking at the actual conduct, the intangible is still owned by US. But when I further go into the details, I see that there are still intangibles sitting in India because the Indian entity taking decisions. And the moment you are taking decisions, controlling the decisions, you are in a way creating that any sort of kind of a intangibles. Now, as I mentioned, it is not necessary that that intangible has to be recorded in the books, but for transfer pricing purposes, it is an intangible. So Indian entity should get more than the routine return. So that is the first step. You need to identify who are the owners of the intangible, and then so there is one legal owner who has developed and there's an economic owner. So the US entity cannot be both the legal and economic owner, because when it comes to the further development of intangible, Indian entity is also taking decisions, doing negotiation, and further improving the overall characteristics of the product or the services. The second is the determine the contractual arrangement between the looking at the agreement. So first is identify the intangible. Second is the agreement. Identify the parties performing function assets risk, managing the risk related to damping. So we'll discuss the damping analysis in the second slide. But the first three steps are very, very important, that you need to look at who are the intangible. You need to look at the agreements, what it is written. You need to look at the functions, assets, and risk based on the damping analysis. We'll discuss in the next slide, damping analysis. And then interpret the outcome from first to three, whether any contractual assumption of the risk is consistent with the actual conduct. So as I mentioned, if the contract say cost plus 10 and the routine activities are mentioned, and the actual conduct based on the damping analysis says, okay, Indian entity is doing much more than that, then there's a mismatch. So then we do an interpretation. And then the next step is where the party assuming the risk does not control the risk or does not have the financial capacity to assume the risk, apply a specific guidance on allocation risk. So this is very straightforward. I mean, any entity is assuming the risk. If it is not controlling, then there is a problem. I mean, controlling the risk is very important. While suppose Indian entity is basically assuming some risk, doing some taking risk in terms of decision making, negotiation, but the entire control is in the hand of US, then Indian entity is not entitled to get the appropriate return. The last step is basically determine the arm's length price of the transaction consistent with each party's contribution. Now, one need to see each party's contribution in the entire value chain. What is the value chain? Value chain is that US is assigning something to the Indian entity to do some services. Indian entity is doing much more than what is written in the contract. We'll do the entire analysis, including the role of the US and Indian entity, and then see who is performing DEMPE, who is controlling the risk, who is taking the decision making, and then we'll come to the conclusion that which entity is entitled to the returns coming out of this intangible for enhancing the functions. Now let's, in the entire steps, we discuss the identification of intangible. We discuss the how, this is very straightforward. Determine looking at the agreement. And then looking at the DEMPE function. Now, it is very important to understand what is the DEMPE analysis. This is a very new concept introduced by the OECD, development of intangible, enhancement, maintenance, protection, and exploitations of intangible. Now, I want to take one more example here in terms of the DEMPE analysis. Suppose I am an entity based in US, and there's an entity based in India. And India is using the platform for the e-commerce activities, which is developed by the US entity. Now, I need to analyze the DEMPE functions. Who has developed the intangible? Who has enhanced, maintenance, production, exploitation? So my example here is that the US entity has developed the e-commerce platform. India entity is using the e-commerce platform for doing the e-commerce sales in India. Now, what is happening is that e-commerce platform, we need to see whether it is unique or not, and for which I need to pay something to US or not. That is the question. Because if you are using the platform and if you're highly dependent on that technology platform for selling your goods, it is very important to analyze whether the US entity is to be compensated or not, because it might not be an issue from an Indian perspective, because if you're not paying, there's no issue from a tax perspective, but it might be an issue from a US perspective, because US tax authority might want a compensation from Indian entity because Indian entity is using that platform. Now the question is whether Indian entity who is using this platform is actually contributing to the development, enhancement, maintenance, using this platform actually, using the benefit of the entire technology. And we need to analyze whether US entity has actually contributed in the development, enhancement, maintenance, protection. So the US entity is entitled to a return only when it has performed these sort of functions. So if I'm a startup e-commerce, I'm paying to US entity for the using the e-commerce operations, but I need to see whether I really need to do that payment or not. I need to see these 5 functions. First of all, development of intangible. Now look at the development of intangible. Who has developed that intangible? US entity has developed the intangible. Now, only development is not enough. One need to see whether that development is unique or not from an Indian perspective. The Indian startup could have used some other Indian software and use that. Why there's a need to make payment specifically for right to use to US entity? Now there what's the importance comes that in terms of looking at the entire uniqueness. So say for example the US entity using the artificial intelligence or augmented reality in that platform, or looking at the implementing any features in the platform or app, such kind of feature which attracts the customer, automatically find the interest of the customer, that makes that platform unique. So those are the points which actually creates the intangible, which is not unique as compared to the other routine functions. So that's what I analyzed, that US entity has developed, their technical team has developed some artificial intelligence which can be used in their app, and which India is using. That is development of intangible, which is unique, which we are justified that development is done by the US entity. Enhancement of the intangible. US entity has launched this app in suppose 2015, and over the period of years it has been enhancing by using some technology, using the technology people or high-tech skilled people or their CTOs. They are enhancing the intangible, and then coming out to the next one, which is the maintenance of the intangible. Who is maintaining? The maintaining is also important. So it might be possible that the Indian entity might be maintaining the intangible, the intangible is owned by US legally, it is developed by US, enhanced by US, but when it comes to maintenance, it can be both. Indian entity might be maintaining the entire security of that intangible, and then coming on to the protection of the intangible, which is US's, because it is legally protected in the US. And the last is exploitation of intangible. Exploitation. Now, US entity, if it is particularly this platform is developed for India, India is exploiting this intangible. So India should get to the extent that returns. Now, in this whole exercise, one need to understand that the entire DEMPE function, US contribution is a lot as compared to India. So India should pay a kind of a remuneration, kind of royalty to the US entity. And that's where the importance of the DEMPE function is, that just because you have done the arm's length price, it is not necessary that the substance is justified. If you want to justify the substance, you need to analyze these 5 aspects, which are very, very important, that who is the contributing the significant economic functions from this DEMPE analysis. And based on the same, you need to decide that which entity is entitled to a return. Now, based on analysis, I decided, okay, the US entity is contributing a lot in DEMPE function. Accordingly, I'll do a comparability analysis and do the benchmark, and then remunerate with the conclusion that based on the DEMPE analysis, the US entity is not only the legal owner, but also the economic owner of what is being done in terms of the entire process. So this is a very important concept in the new world, and tax authorities are focusing more and more in this DEMPE analysis. While it is not specifically introduced in the tax transfer pricing regulations, but when you go into the litigations before the tax authorities look at this substance in terms of the development, enhancement, maintenance, protection, and exploitation of intangible. So this is the broad framework in terms of the key factors to determine the arm's length principles. So if it is an intangible X, you need to see the development, and you need to fill this table that who has developed this, who has enhanced this intangible, who has maintained, who has protected, and who has exploited. So DEMPE is a functions you need to, who is performing and who is control. So as I mentioned, this is very important to understand. Only performing is not enough. You need to control. So what is the difference between performing and controlling? You may perform something, but you may not control. Control means taking the responsibility of the entire risk of the functions. Okay, so you are controlling as well along with the performance. You need to see the control as well. And then funding is also important part. While funding does not play a very important role in terms of the compensation for the enhancement and the development, functions and risks are the most important thing. A question here arises in the new world where, and that is one of the question which I raised in my paper, is that if I, as an investor, I invest a lot, I don't do anything, why I am not, supposed to get a maximum return? But that is, something very debatable. I mean, just because you are an investor, you might not get that much of return. You need to do some contribution, and that's what the expectation of the tax authorities, the expectations of the OECD and United Nations is that, just because you are investing something, you might from a intra-group, from a transfer pricing perspective, you might not get return. While these things, might be relevant in other sort of model. You must have seen the startups and all. Investors get the most return while they don't do anything. But in the when it comes to transfer pricing dealings, the intercompany dealings, it is very important to justify the substance. You cannot get any returns without having any substance. And you must have seen previously there has been cases where IP holdings are situated in some other countries, operations are done in some other countries, and those sort of models are not appreciated or are at risk in terms of the transfer pricing scrutiny, because in transfer pricing, substance plays a very important role. You cannot have a company just for the IP holding. You have to have a substance. Or if you are holding a company only for IP holding, that company is not entitled to any returns, because that company is not doing anything. So the functions funding and risk are very important, and out of that, functions and risk are very, very important. Perform, control, and when it comes to risk, it is control and bear. Now, when it comes to functions, that might be one possibility that I might, perform. I might outsource some functions. So it is possible that I am as a legal owner, I might outsource some functions. It does not mean that I am not controlling the decision. I might outsource function, but end of the day, it might be my responsibility. So that sort of things one should keep in mind, that outsourcing is not a problem. Controlling is the point. How much, to what extent you are controlling that function, to what extent you are controlling and bearing that risk. That is what is the most important. End of the day, are you taking the decision making? End of the day, are you responding to that risk? End of the day, are you taking responsibility to mitigating the risk? The entire responsibility matrix you need to see. So this is the broad framework when you do the analysis. So in the pre-BEPS world, the allocation of risk is identified through contract between the party. As I said, the contract and the conduct. In the post-BEPS world, the actual conduct of the party in terms of how much and what type of decision-making capacity to be evaluated to support the contractual risk. Now, it is not only conduct. Conduct has to be supported with the decision-making. If I am doing the conduct, which is, as per contract, or might not be as per contract, but if I am not taking the decision, it is as good as, as per the contract. So decision making, taking the whole responsibility is very important matrix in the whole analysis. Coming on to the key factors to determine the arm's length principle. Now, risk is an important factor for performing the arm's length analysis. As I mentioned, functions is important, risk is also important. Unless you don't assume or control the risk, you are not entitled to any return. So the functions and the risk go hand in hand. You cannot just analyze the functions or DEMPE and you conclude on the arm's length. You need to analyze the risk. And analyzing the risk, it is very important to do a two-side analysis. So you must have seen in transfer pricing documentation, many people are, do the one-side analysis. Like in Indian companies entering into transaction, analysis is done based on one side. I mean, it means that if Indian entity is a support service provider, the other entity is automatically an entrepreneur. It does not necessarily. So in the pre-post BEPS world, it is very, very important to do the two-side analysis, that the parties who are part of the transaction or parties who are part of the entire value chain or the related party transaction, both the parties, the function, assets and risk to be analyzed, And based on the same, one need to conclude. So 2 steps, 2-side analysis is very, very important to see the entire value chain. And then looking at the risk, one need to do the proper characterization and do the comparability analysis. Okay. Now, this is very important that while I spoken about the outsourcing of the functions. Okay, so while functions can be outsourced, but risk cannot be outsourced. The moment you are outsourcing the risk, it means you are outsourcing your returns. I mean, you are no more entitled to any return. If you want to entitle to any return, first you need to control the function, you need to assume the risk, you need to control that risk. Then only you are entitled to a return. If you're outsourcing the risk, it means you're out of the picture of getting the remuneration. So risk is very, controlling the risk is very important, and you cannot just outsource it. Then contractual allocation of risk without sufficient control will not be regarded at arm's length. And that's, I'm repeating this is very, very important. Without control, you are just contractually assuming the risk. The end control exists in terms of in the hands of some other entity. This is not, will help you get the required or help you in concluding the ALP. In order to conclude the ALP or get the required remuneration, you need to assume and control the risk, not along with the perform and control the function. So in terms of the risk, these are again the 6-step process, which you need to identify the risk. You need to see the agreement. And similarly, like functions, we have seen that you have to see the agreement, you see the actual conduct. So you need to see the economically significant risk. You need to see the contractual assumption of risk. You need to see which parties are performing functions related to risk. And then you need to interpret the entire steps and then allocate the risk based on the functions. Now, this entire process, as I talk about, that profit split method might be relevant because there might be a possibility that both the entities are taking the risk. So in that case, the profit split method, it means splitting the profit might be useful. So one need to see the entire possibility, one need to do the entire analysis and then see that which entity is contributing a lot in terms of development or enhancement of the intangible. So this is all on the risk. Now coming on to this is the very important part of the analysis, that in terms of which entity will get the returns out of the intangible. As I said, intangible is very, very important for any business. I'm sorry. So if I talk about contribution, the first is basically entity funding the intangible is not entitled to any return. It is on, if it is only funding the, so I'm on second step because I'm talking about entity only funding the intangible. So if any entity is only funding the intangible, it is entitled to a risk-free returns like government securities, like that, low risk, because I am funding. And that, as I said, this fundamental is very important in the transfer pricing world, that if you're not doing anything, you're not entitled to any returns. You're entitled to only risk-free return to the extent you have invested, and only risk-free return. But coming on to the first scenario, if entity is funding the intangible and taking control over risk related to intangible, that entity is entitled to a risk-adjusted return. So you must have seen risk-adjusted return is computed based on various ratios, Sharpe and Tanner ratio. So we'll not go about the computation mechanism. The fundamental here is that the difference between risk-adjusted and risk-free returns comes only based on the who taking control of the risk in relation to the intangible. Give me a second, please. Yeah, so sorry for the delay. So we are talking about the returns intangible. Now, if any entity is, as I talk about funding of intangible, it is entitled to only risk-free returns. If any entities which are funding and taking control of risk, the entity is entitled to a risk-adjusted return. So as I said, only legal ownership is not give you entitlement for or return. You need to do some control of risk. Now the third is basically, so say for example, if Indian US entity has developed the intangible over the period of years, so and it has taken control over the risk related to intangible which is further developed, then US entity is entitled to risk-adjusted return. Now suppose the Indian entity is enhancing or developing the intangible further, then the Indian entity should be attributable to intangible to the extent of performing these functions like development, enhancement, maintenance, protection, and exploitation of intangible. So these are the 5 functions. So in my hypothetical scenario, it might be possible that US entity taking entire return, US entity not taking other than risk-free return, Indian entity is taking the entire return related to DEMPE, because Indian entity is not entitled to a return related to funding, or because funding is done by US entity. So there could be possibility. So one need to see who is controlling the function, who is performing the DEMPE functions. Yeah. So moving on to the another. So this is the main function related to intangible. Moving on to the hard to value intangible. This is the another. Sorry. Give me a second. There's some interrupt. Please give me a second. Give me a second. Yeah. So coming on to the hard to value intangible, this is a really interesting concept launched by the OECD revised guideline. What is hard to value intangible? So there might be a possibility that some intangible are not fully developed, partially developed. Suppose any software which is fully not developed, and then that intangible is transferred. How do you value that intangible? And that is very important concept in terms of the valuation of intangible and transfer, that one need to see the ex post outcome, because at the time of transfer there's no comparable exist, there's no independent third party exist dealing with the same intangibles. Now if I talk about this hard to value intangibles, it is very important that one need to see the ex post outcome. So when I transfer this intangible, I see the forecast of in terms of the overall benefit of this intangible, and based on this forecast, I'll decide that how much profitability is generated based on this transfer of intangible in next 5 years. Now it is very important that when tax authorities see it after 5 years or so, they will see the ex ante, ex post. Ex ante means the projection done at the time of the transfer, and ex post at the time of actual. If there is a difference between the ex ante and ex post, then you need to adjust those intangibles. So this is the overall fundamental of the hard to value intangible, and this is the latest concept, because there might, in such a digitization world, it is possible that such intangibles are not, it's very difficult to value or find the comparables in a third party scenario, and then you do the forecasting profitability, and after the years and when we see the actual results, if there's a lot of differences, one need to do the adjust the margin of the companies as well. Now coming on to the overall BEPS action plan in terms of India perspective. So if I talk about the Indian perspective in terms of the overall guidelines, India has been facing a litigation in terms of the marketing intangible research and development activities, where the tax authority is claiming that Indian companies are contributing a lot in terms of the R&D function, contributing a lot in terms of the incurring marketing spend and promoting marketing intangible for the overall group. This BEPS guidelines will play a lot of importance in terms of conclusion or solution, because these cases like marketing intangible issue is with the Supreme Court. But if we see with this guidance, where the transfer pricing outcome should be aligned to the value creation. Before dealing this issue, like any R&D activities happening in India and any entity is taking a lot more risk, if we do the analysis, who is doing the value creation as per the DMP function, it would be more easier in terms of finding out which entity should be compensated for the marketing intangible and for the R&D activities. So this is all about from an Indian perspective, that considering that a huge amount of litigation happening, for any entity which is facing such sort of litigations, it is very important to do the entire DMP functions analysis before coming on to the conclusion. We'll take one or more case studies out of this, and then we'll see how it is overall impacting the Indian scenario as well. But if we talk about the broad potential impact of the plan, is that in terms of what OECD has introduced. The first is the broad definition has been introduced in the transfer pricing, which will make easier for the taxpayer to look into the entire structure. Earlier it was difficult to which is intangible and which is not. Now it is broad, so it's easier. It makes difficult also for the taxpayer because they need to see the entire value chain in terms of the analysis for the entire group. Now, the second aspect is DMP contributors are remunerated on one-sided, reliability and transfer pricing reduced. So if one-sided analysis is not done, reliabilities will be reduced. Review the value chain in light of the new definition. You need to do the entire value chain analysis, not only one-sided analysis. Greater emphasis on the parties' commercial conduct, characterization and intercompany agreements. So while intercompany agreements are important, comparing with conduct is also important. Entity taking significant expenditure should be entitled to more than arm's length return. So I as an entity is incurring significant expenditure and contributing a lot to the intangibles. I should get the more remuneration, but that intangible, if it is owned by the US entity and I'm contributing to them, but if I'm doing for my own, then I might not get, there's no need to get the extra remuneration because I am doing as an entrepreneur. So one need to see that such expenditure is incurred as an entrepreneur or as a service provider. So this is very important. And last, not the least, one need to see the critical functions in any DMP function: design, management, budgeting. These, so in a particular activities or let's say manufacturing functions, these are the core important functions. So accordingly, one need to decide the overall potential impact. What are the challenges of this BEPS Action Plan 8, which I observed? The one important one key challenge is that one need to evaluate the entire value chain. One cannot leave anything. One need to see the entire value chain and then analyze the functions. And now with the digital world, it's very difficult to identify which functions going where and who is responsible, who is taking the risk, because a lot of things are at cloud and it is very difficult to identify. And that's where the OECD has come up with the pillar 1 and pillar 2, which I'm not covering this presentation, that how the allocation is to be split in a digital world. Is there any different formula which is required? Because digital is something will change the entire approach of the tax authorities, the way things are digital, even entire business happening on digitally. I mean, people, there's no requirement to shift people. Earlier there was a requirement to shift people. Economic activities are shifted from one jurisdiction to another jurisdiction. So those sort of things are happening now. If we talk about DMP analysis, this is putting pressure on the defining correct intercompany pricing. Difficult to find comparable independent party undertaking DMP functions. So this is one of the critical challenge in terms of the entire analysis, that while OECD introduced the DMP function, but when we do the section 16 sorry. I could not hear you. Any message for me?
No, you please go ahead. Ajitji, you please go ahead.
Okay, sorry. Okay, so let's talk about the challenges of BEPS Action 8. So I spoke about challenges. So one of the key challenges in the BEPS Action Plan 8 is basically how we will find out such DEMPE companies which are performing similar DEMPE functions. So while we do the analysis both side, US company and Indian side, but when we come to the comparability analysis, we don't have that much of information of the comparable companies in terms of their functions, their DEMPE. Now, this is a very difficult question to answer. You need to do the broad analysis. And considering that you will do the broad analysis, you will find the broad comparability. You will select a broad comparability criteria to come out with a conclusion. Another challenge is if there is no comparability exists, then doing the price adjustment is very difficult, because you do the price adjustment based on the comparable only. Now, another challenge of here is legal owner intangible is earning the risk-free return. As I mentioned, if I am putting on any investment, I should earn only risk-free return. But then the question here is, this is very interesting, that whether the same principle applies in case of the loan transaction or not. Because in loan transaction, the tax authority expect to get not risk-free return, but a proper arm's length compensation as compared with third party. But both are different transactions. But as I mentioned, this is a debatable area, and what you are applying to intangible, you cannot apply to a loan transaction. So this is one of the more important challenges. Another important challenge is basically possibility of using profit split method to determine the arm's length allocation savings and comparable transaction which are not available. So in the entire analysis, there is a possibility of using PSM profit split method, but it's not really straightforward. You need to do the entire value chain analysis. So if I, as a company situated in India, my company, there's a company based in Singapore who is taking the strategic decision. There's a company in US who is holding the IP. It's not really easy task to determine who is the holding IP, who is taking decision, who is taking strategic decision, so on and so forth. So there are, while the efforts made by the OECD is really appreciable. I mean, they have made a significant effort in terms of coming out with this guidance, but there are practical challenges as well. It's not straightforward to implement this entire guidance into any tax regulation easily, because to some extent some things are theoretical and one need to see the practical aspect of it. One cannot generalize and introduce any regulation because it depends on case-to-case basis. And one important aspect which I missed in my presentation in terms of computation of the arm's length price and this OECD guidelines. So if you really see this, the whole concept of the arm's length principle is coming out from the Article 9 of the OECD Model Convention, okay, which says about the comparability analysis and performing as compared to the third party, and accordingly you determine the arm's length price. That's it. OECD Model Convention Article 9 doesn't talk about the value creation. OECD Article 9 does not talk about the conduct and the contract. Does that mean that are we moving beyond the arm's length principle? Now that's the question, debatable question, and that's where the lot of other efforts are being made, introduction of MLI or a change in the tax treaties and all. But the arm's length principle as it is coming from Article 9, is there any change in the amendment of Article 9 or not? That is a debatable question. But overall, if we see this is to some extent going beyond the arm's length principle, and which I need a need of the hour. While you can say this is a extra layer of arm's length principle, but substance is very, very important. Conduct versus contract is really, really very important. Otherwise, the whole objective of the transfer pricing will not fulfill. The objective of transfer pricing is to avoid shifting profit from one jurisdiction, to avoid the base erosion. If there's no conduct, if there's only arm's length comparability analysis, this will not help. So these are the key practical challenges. I have put down the overall impact of the transfer pricing, action 8 to 10, overall impact. I'll not go into the detail because it is the same what I have already spoken about, but there are certain case studies which I have, I want to discuss here in terms of to make sure that what I spoken is aligned to what is the practical aspect. So let's say I company is based in India, R&D center. I company is in India based R&D center of ABC Group. Now ABC Group is based in Luxembourg. Indian company is doing R&D. Now ABC company is a legal owner and develop the intangible over the period of years. ABC company is giving cost plus routine return to the I company for the R&D activity, while Indian company is doing much more functions than the R&D function. Now the question is how you deal with the current MP analysis. That is what is the question. Will you remunerate the Indian company based on cost plus, or will you remunerate the Indian entity based on the function, assets, risk, detailed MP analysis, detailed risk, who is controlling the risk? That is important. The second case study basically is talking about marketing intangible. And as you have seen the huge amount of litigation in India, I as a distributor in India incurring significant amount of marketing. You must have seen many FMCG companies are incurring significant advertisement and marketing expenses in India. And tax authority raised the question that since you have incurred a lot of marketing expense in India and you are promoting the brand of your foreign company, you should get remuneration. And that's what the whole dispute comes, that the Indian tax authority argued that although I am incurring a lot of expenditure, this is only for my own Indian market. This is not for something for my market outside India. That's what I don't need to get any remuneration from outside company. Although I get a license to sell those goods, although I am doing excessive marketing, that is for my own use. That is not used for my foreign parent company. That is for my own use. And for my own use, if I'm doing, I should not get any remuneration, because end of the day, if I am getting any profit or loss, I am as an entrepreneur should bear it. Who will bear loss if in case I incur loss after this advertisement? My parent entity is not going to bear that loss. So that is the litigation. And with this new guidance, where you need to evaluate the entire value creation, DMPay, controlling the risk and everything, I would say, becomes easier to find out that who is the real economic owner of that intangible, if at all created. If any marketing expense is not creating intangible, that is not an issue. But if at all you are creating, are you or the owner or the US company is the owner? That is the question. And that question can be answered once you do the DMPay analysis of the intangible. And then you can argue before the tax authority that although I have incurred these, I have incurred these expenses, but look at this development, enhancement, maintenance, protection. All these done by me for myself. I should not get remuneration from the US entity. So this is the second case study. The third case study is also important, where the holding company of the ABC Group is ABC company is the holding company of the ABC Group. It's funded its associated enterprises for the development of the IP. ABC company IP development was registered in the name of ABC company. The company was remunerated for IP development on a cost plus basis. Now, ABC company has developed the intangible. The company remunerated on a cost plus basis for the development. But ABC company takes major decision on account of control and management of IP. Now, here is the different case. ABC company, ABC Group is owning the intangible. It is taking the major control and taking decision of that IP. ABC company is only developing the IP. It is not taking decisions of the IP. So in that case, ABC company is entitled to a risk-adjusted return, because it is not only funding the intangible, but also it is taking the control and the risk related to intangible, while the D company, which only developing the intangible, should be entitled to a routine return. But here, as I mentioned, it is not that straightforward. One need to analyze the entire DMPay function. One need to speak to the key people of the company. One need to do the entire risk analysis, function analysis, then come with the conclusion. So this is the entire, these are the three case studies in terms of understanding how the new regulation would change the entire scenario when it comes to the transfer pricing. Earlier, we used to compute the arm's length price based on the particular benchmarking report, and we are done. It is an arm's length, it is done. But in the new guidelines, you need to talk about substance. You need to see the substance. You need to see the conduct. You need to see the risk, control, everything you need to see, and then come up with the detailed metrics in terms of the entire value chain. So that is the biggest difference, and that will definitely change the way how we deal with the transfer pricing and how the company manages their transfer pricing. So I'll not go into the specifics of this marketing intangible, because I have already discussed. I want to discuss this payment of royalty. This is really very, very important. While I spoken about one example of the royalty in terms of the e-commerce company paying royalty to US, and in Indian companies paying everything, but in terms of the entire issue from an Indian perspective, how paying royalty is challenging. So I want to take a simple example of a particular company. Suppose a particular company, a big FMCG company, is have launched the product in 1990s in terms of suppose a kind of a or a pharma company tablet, or kind of a for cold and cough. Suppose I'm giving an example. I'm not taking the name of a company. For a particular company, pharma or FMCG, launched something in 1990s in terms of the cold and cough, and that FMCG company in US introduced in 1990. A license is given to India in terms of use of that technology for manufacturing and further sale of that tablet or whatever you can say for use for benefit of cold and cough. Now what is happening is, over the period of years, when the license was given from India from US to India in the 90s, the US company started charging royalty. Okay, from Indian company, and as the Indian company started paying royalty year on year, and they are justifying the royalty, said, okay, we are paying royalty because we are using their technology, they are providing us the technology, and we are paying that technology because and due to the technology, our market share increased. Due to the technology, customers have attracted. Due to the technology, we are in the competition. That's what the argument be taken. But what is happening is, over the period of years, from 1990s to 2015, there is no change in the technology. The technology which is being developed in 1985 is the same. A product technology or product formula, I would say, not technology, is the same as in 2015. Now, the valid argument the tax authority might raise, that if there is no change in the technology, why you should pay any fee for technology? I mean, this kind of fee or this kind of payment, where year on year there is no change in the technology, it's kind of a, you are paying for nothing. I mean, over the period of years, you can develop a similar technology or formula in India to develop the same product. Why you are paying for a formula which is same as which was there in 1990, and today it is the same. So that is what is more important. For any payment you are making the royalty, you need to make sure that you are making payment for any non-routine intangible, a unique technology, unique formula. Over the period of years, if you are not making payment for a unique, or there might be a possibility that tax authority might disallow the payment on the ground, not because it is not arm's length, but because there is no substance behind it. So uniqueness, this shows the importance of the uniqueness, that while you are paying the royalty, but there is no uniqueness, you are paying over the period of year. That is first important. Second, the important concept in the royalty is the benefit test documentation. Now, benefit test documentation is very important. The concept is very important in the royalty and or paying for any services. If you are making payment, you need to document the benefits coming out of it. It can be your formula benefits, it can be your market share increase, it can be your customer competitiveness, it can be anything which you can show that these are the benefits which are generating more revenue, more customer, more market share in India. That is an important concept. The second thing, if you are an entity in India incurring losses and you are paying royalty, then you have more risk in terms of the scrutiny, because and at this one side you are paying the royalty, at the second side you are incurring the losses. So the important question comes is, if you are paying the royalty, are you supposed to incur losses? Yeah, this is a very important question. Now, Yes, you are supposed to incur the losses provided you are a real entrepreneur in the market, and you need to justify that you have incurred losses not because of the payment of royalty, but because of your market penetration strategies. So you must have seen many FMCG companies, introduce the concept of one-to-one free, or some various, voucher concept, or marketing distribution concept, or free concept. So those kind of, schemes, may result into losses. And those are the penetration strategy, and those does not conclude that in a way, the company has incurred losses because it is paying royalty or something. Though that you need to justify based on the facts of the case, based on the going through the entire business operation, and then you need to justify. A very robust documentation is required to be submitted before the tax authorities when it comes to royalty or justification. And specifically, if you are incurring a loss, you need to justify that I am not incurring the loss because of the royalty, but because of the business circumstances. So this is the very important royalty concept in terms of the royalty, and an important message, which I already explained here. I will not go through. Now, there are two more concept. I'll quickly go through, and then we'll take if there are any questions in terms of the entire presentation. And so the first, the important, model, which is I feel is very interesting in terms of the DMPA and IP licensing. You must have seen the fundamental. You must have seen the model of a parent company and a holding company. You must have seen the model of a parent company and a IP holding company, operating company, and distributor, and the client. Okay, so what in this particular model is that there is a parent company who is developing the intangible. What it does is this parent company is transferring the entire IP to IP holding company. US company is developing, IP holding company is Singapore. So US is developing, Singapore is the IP holding company. It's just not doing nothing. Operating company is suppose in India paying royalty to IP holding company. Okay, and then Indian company has some distributor and client and so on and so forth. Now, while I'll not discuss, this is kind of an exercise you need to think in terms of what I discussed, in the entire presentation. In the pre-BEPS world and the post-BEPS world, if there has been any compensation to be made between those, so suppose parent company compensating to, parent company transferring, an IP holding company compensating to parent company for the IP, Indian company is paying royalty to IP, and then Indian company as a distributor. How will you, determine the remuneration based on this structure and based on the DMPA analysis, given that IP holding does nothing? It is just holding the IP. So you need to see so this is, as I said, this is a kind of an exercise for you. You need to do this exercise and, evaluate that what, not only from Indian perspective, but US and Singapore perspective, how do you analyze the entire scenario from a post-BEPS perspective? Which entity should get the maximum return when it comes to development of intangible? So this is kind of exercise, and I feel this is very interesting, and you can have a look, and if any questions we can connect, or we can I can give my thoughts.
Thank you, CA Ajit Jain ji. We can stop screen sharing?
Yeah, sure.
Thank you very much. Over to Dr. Amit Agrawal.
Thank you, learned speaker. You have deliberated on a very interesting topic today, and we have shortage of time. So I would request Honorable Chairman to take up the queries of the member. Over to Chairman, sir.
Thank you very much, CA Ajit Jain ji, for nice deliberation, and Dr. Amit Agrawal ji. We are having certain queries from each and every part of the country. We are having the queries. So we are having the presence of Neetu ji and Devendra Kataria ji.
Yes, sir, I'm here.
Devendra ji, you are having the queries with you. Will you ask the query?
Yes, sir. Some of the participants have raised certain queries. Although, sir, you have already deliberated very nicely on the action plans 8, 9, and 10. But some of the participants have a query, right? Can you please tell us what are the changes expected to be introduced in BES Action Plan 9 and 10, considering the growing importance of the emerging areas of risk management across numerous industries and entities? What are the expected changes, sir?
See, yeah, so this is a very good question. Now, just to answer this question, basically, see, this transfer pricing guideline introduced in 2015, and when it was introduced, OECD has introduced a draft model of it in 2014. Now, in last 5-6 years, and just when it was, sorry, there was some disturbance. Yeah. So when this was introduced finally in the OECD guideline in 2016, and then OECD new version has come in 2017, it was expected that the tax regulation of many countries will introduce the concept of the conduct versus contract and the risk in the tax regulation. But as I mentioned, this is a kind of a business reality, and this is very looking at the practicality of the entire concept rather than converting into the tax regulations. So as I mentioned, this conduct versus contract, while it can be introduced going forward in the tax regulation, that not in a tax regulation, but might be in a tax guidance, or might be in a guidance way format, because this is kind of a guideline. As I mentioned, Article 9 is not amended, but there's a guidance has come. So CBDT may come up with the guidance that you need to see the substance, you need to see the conduct versus contract. That kind of thing might be possible. But introducing exactly in the tax or transfer pricing regulations seems, I don't see the possibility, because this is a very, concept which might differ from different taxpayer and different scenarios. So making it very generic might be cause a problem, not only for the taxpayer, but also for the tax authorities. So while these concepts, this Action 8, 9, and 10 are very relevant for the entities where the intangibles are more valued, say for example, life cycle industries, FMCG industries, where value chain plays a very important role, where the supply chain or manufacturing industry, supply chain plays a very important role. So those industries, this Action 8, 9, 10, while it is important for all the industries, but for specifically those industries which are based on a particular supply chain, or a supply chain plays a very important role. For them, this Action 8, 9, and 10 is very important. But anything introducing in the tax regulation or transfer pricing regulation is very subjective.
Devenji, you are having any other query?
If the time permits, I have one more query from the participants.
Yeah, please ask.
Okay. Sir, there is a question raised from the participant that to what extent India has replicated and implemented practical scenarios of BEPS Action Plan 8 to 10 as compared to other developed nations, and what are the aspects which still needs to be addressed?
Yeah, so as I said, it's not practical to introduce this, replicate the entire concept in the transfer pricing regulations, because these are very subjective. These are subject to a lot of ambiguity and interpretations. Different people have different interpretation in terms of, so as it's like value creation is not defined in the entire guideline. DEMPE, what is DEMPE is defined, but to what extent DEMPE is to be analyzed, to what extent it is outsourced, it is not analyzed, so it is very subjective. But from an Indian perspective, as I said, like Indian Tax Authority, CBDT has come up with the R&D circular, which specifically says that one need to see the substance of the R&D activities, while it was not specifically in relation to what is there in the OECD guidance or BEPS, but the Indian entity has given an indication by introducing such a circular in 2000, I think, if I'm not wrong, 2013, where they have come up with that a lot of Indian companies are performing R&D, and they are only remunerated with the cost plus return. But if you see the real substance, they are doing much more work. So the CBDT has come up with the guidance that they need, the Indian entities, while doing the transfer pricing analysis, they need to do the substance analysis, whether they are doing more than the routine functions or not. So going forward, my understanding is that given that the change in the structure and given that the change in the change after post-COVID, the entire supply chain is changing, the Indian Tax Authority definitely going to give more focus on substance as compared to the plain vanilla arm's length regulations.
Yeah.
Thank you so much, sir. Thank you so much.
Devenji, you are having any other query?
No, sir, no other queries for me.
Tusharji, you are having any query with you?
No, sir.
Lokesh sir, you are having any query?
No, sir. No, sir. No query.
Yeah. Then Ajay Yadav ji from Thane, where to find the transfer pricing report and comparable to prepare transfer pricing report? Is there any site for that?
Sorry, can you repeat?
Yeah, he is asking where to find the transfer pricing report and comparable to prepare transfer pricing report. Is there any site for that?
See, so just to, this is more of a transfer pricing compliance question, and from an Indian transfer pricing perspective, transfer pricing is basically as far as my understanding, because now I am 3 years away from Indian transfer pricing. I'm more handling into the Middle East region, but as far as my understanding is concerned, in terms of the Indian transfer pricing, there is no requirement to file the transfer pricing local file or documentation with the tax authorities unless it is requested by them. That is what is my understanding. What the taxpayer needs to file is the form 3CB at the end of the compliance period, and those whatever is written in the form 3CB has to be documented properly in the local file. Now this local file has to be, as far as my understanding is concerned, is to be submitted with the tax authorities, and that would be the base for the entire analysis.
Anuj sir, unmute करना पड़ेगा.
Yeah, sorry. CA Nihal Kumar from Delhi. Sir, if a company situated outside India sends remittance to an Indian company in which the shareholders are also the shareholders of companies situated outside India for a provision of business and management consultancy and public relations services, the services that the Indian company has taken from its Indian vendor for its functioning in India, what are the compliances the Indian company has to do it in respect of GST, TDS and FEMA?
Sorry, I mean, I appreciate the question, but apologize. I mean, this is something not my area, so I won't be able to.
So I think we'll try to, Amit will try to answer it separately. Then Dinesh Kumarji from Delhi, whether money measurement concept applicable?
Money measurement in terms of what? I mean, if the question is more elaborative, that could be more. If I
think he will ask again. I think I will request Dineshji to ask again. Then Dineshji from Ludhiana, sir, to determine ALP, whether any new database is there other than Progress and Capital Line.
As far as my knowledge is concerned, the majority of people are using Progress and Capital Line. But if I'm not wrong, there is one more database. I don't remember the name of that database. That is actually used by the tax authorities. A lot of transfer pricing officers in India are using that. I can give the name separately after this session by finding out. But majority of people use this Progress and Capital Line.
Yeah. Then CA Darshan Jainji from Mumbai, while driving ALP and method, MLI multilateral instrument impact.
So, as I said, multilateral instrument is a kind of a concept to bring changes in the tax treaties, while it does not have any direct impact on the day-to-day compliance, where you need to do the compliance and compute the arm's length price. But as and when the MLI comes into the picture, it's very important to the entire structure.
Yeah. Then CAK Madhvanji from Chennai, can we use cost plus method for parties undertaking DEMP function for calculating transfer pricing?
Yeah, this is very important and very good question. So just to answer that, so can we use cost plus for the parties, conducting DEMP function? See, DEMP is what? Development, enhancement, maintenance, protection, exploitation of intangible. If I am doing all these functions, it means I am taking control of that functions. If I am doing this function, it means I am taking certain risk. If I am doing this function, I am taking control of risk. And if I am doing these functions, then I should not be remunerated at the cost plus. Cost plus is what? There's 100 rupees cost and adding 10% markup, 110, you will never incur a loss. If you're doing all these functions, you are taking a risk. And if you're taking a risk, who in this world will take the risk and get only cost plus return? I will never take. I will always demand for more compensation. So a cost plus return for a company performing a DEMPE function is something which not appropriate in line with the business reality.
Sir, your mic is muted.
Sorry. Then we are having one. Yeah. Deepak Jain ji from Mumbai is telling about. Is asking about Bloomberg database.
Yeah. So Bloomberg database is particularly used for loan transaction, not for the other tangible rate transaction. So mostly when you have a loan transaction interest, you need to use Bloomberg databases for finding out the comparable interest rate.
Yeah. Then CA Sunil Nayak ji from Navi Mumbai. If one entity does the marketing functions for group entity, and it also a contract signing entity for administrative convenience, then will this leads to that entity owning the marketing intangible?
Yeah, so again, this is a very good, a very interesting question. The question is, if I am as an entity doing the marketing function, whether I am creating an intangible or not. Okay, now just to answer this question, if I am doing a marketing function, am I taking the enough risk? So suppose if I am doing the marketing functions and today, tomorrow there is a loss, or tomorrow there is a something different in terms of the loss of customers or anything, will I take the hit on my compensation? Or as a distributor, I'll still take the assured margin and do the marketing function. So if I am doing if I am taking the risk, I should be entitled to, I will developing that intangible, even if it is a loss or profit. But if I'm not taking that risk, what I will do, I will take the compensation for my distribution activity. Along with that, I also get the remuneration of the marketing expenses which I incur, because at the end of the day, I'm not taking the risk. So it all depends upon how you control your function and how you take your risk.
Yeah. Then V. Subramanian Iyer from Kochi. Many MNCs are selling their global brands in India, for which ads produced outside India with the foreign models.
Yeah. Yeah.
So, yeah. And in continuation of that, he is asking, sorry for disconnect in the above case. Can it not be construed the foreign ad is an intangible service to the Indian company subject to transfer price?
No, this is a really interesting I would say argument, and this is the argument. In fact, argument I have taken in my his career before the tax. What is happening is when I incur marketing expenses for my group company, the tax authorities is arguing that you should get the remuneration. At the same level, I can argue that if a foreign entity is doing the advertisement with the model, with the product, selling in India, whether should I get the similar compensation for? Should I make payment for the same? Because at the end of the day, is benefiting for me. Now, this is a very subjective question. Because if the tax authority will agree that okay, you are doing on your own, they should also accept that okay, you need to pay something because it is doing something for our benefit outside India. So as I said, it is very subjective. if tax authority is accepting one thing, they need to accept the other thing as well. So it all depends upon entire MP analysis and everything. But end of the day, I would say that any compensation is not depend upon who is incurring compensation. This is very important to understand. Any compensation is not dependent on who is incurring. Any compensation is dependent upon who is taking the risk, who is controlling the function, who is the performing the entire MP functions, and who is responsible to make that is what is more important.
Yeah, thank you. Then CA Darshan Jainji from Mumbai, holding company IT services, is executing the contract with the direct customer and subcontracting the same to Indian AE IT services based on the hourly daily basis. What should be best method for computing the ALP 100% AE turnover risk taking by parent company?
Now, if it is risk taking by the parent company and Indian entity performing a role of a service provider, so here it is very important to understand the difference between the transfer pricing policy and transfer pricing method. A policy in the agreement can always be a cost plus 10%, but transfer pricing method depends upon the entire analysis. So while in this case, as per the agreement, Indian entity can have a cost plus 10% margin, but in the method, it can be a transaction net margin method. So there's a lot of confusion. I have seen this confusion many times that people say that okay, in the agreement and cost plus 10. While doing the transfer pricing analysis, the method is cost plus 10. Transfer pricing policy is cost plus, but method can be different. Method can be transaction margin method as well. So one need to analyze cost plus is right policy. The transfer pricing method can be different based on the analysis of the 5 method.
Yeah. So I think we have to conclude. A lot number of members, very senior member, C. Anil Bapna ji from Bombay, CA Kailash Chand Gupta ji from Noida, CA Savita ji, CA Deepak Jain ji from Mumbai, and Aditya Kumar Kesri ji from Devgar, Anju Sarda ji from Surat are appreciating the delegation of Ajit Jain ji and the efforts of the Kota branch and our research committee. So thank you very much, Ajit ji. Over to Dr. Amita ji.
Thank you, Ajit ji and Chairman sir, for taking up this wonderful Q&A session, question and answer session. So it is really very informative session, and the way you did the question and answer session, the more doubts are also resolved, and whatever is left, we assure that we will be reaching the members through over email, and we will be trying our level best. Visual of this.
Sure. And I would like to, thank, ICAI and the Central Committee and CA Anuj Sarji and everyone in the committee, Dr. Amit Agrawal ji and Tushar ji and Lokesh ji for giving me this opportunity. And I would like to apologize if there's any disturbances during the session. And it was really an honor to present and share my thoughts on this important topic.
So Ajit ji, for really it was very insightful. Now I request Deepak Shingla ji, Secretary, Kota Branch of CIRC of ICAI, to express his formal vote. Over to Deepak.
Thank you, sir. Thank you, Mr. Agrawal ji. I am very thankful to our honorable speaker, Ajit Jain sir. He has enriched our knowledge and our participants. And I also very thankful to our Central Council member, Anuj Goyal ji. He is also Chairman Research Committee of our Research Committee. He is always motivational and energetic for us. I also thanks Amit Agrawal ji to moderate the session. I also thanks all the participants who joined and give this valuable time. I thank you very much. I thank you everyone. Thank you very much.
Thank you, Deepak Singhal ji, our Honorable Secretary of Kota Branch, and Lokesh Maheshwari ji, Chairman Kota Branch, Tushar ji, Treasurer and Sikasa Chairman Kota Branch, and all our honorable viewers from each and every part of the world, and of course CA Ajit Jain ji for nice deliberation and answering the queries, and helping the Institute of Chartered Accountants and the Research Committee in its endeavors to really do something concrete for the cause of the profession. for the cause of the nation. Thank you, Dr. Amit Agrawalji and CA Amit Agrawalji, our secretary and the senior officer of the research committee. And I will request all our honorable delegates, around 5,000 delegates are there from each and every part of the world. And particularly those chartered accountants who are in India, because in India now the second phase is there. However, it is coming down, but still the risk is there. So I will request all of you to please stay home. Please take very, very good care of yourself and your family members. And please try to get yourself vaccinated at the earliest and your family members vaccinated at the earliest. So please take very, very good care of yourself. Thank you very much.